The following is a chart of the S&P 500 going back 2 years. This was the high made on January 4th, 2022 of 48,1862. This was the low made on October 13th, 2022 of 34,9158. And this is the current price as of June 21st, 2023. And this video will analyze whether or not the market will go on to at least test, if not take out these lows. Now I'm going to play 3 clips in succession of this video. Scott Wapner, Joe Terranova, Jenny Harrington, and Steve Weiss. It was posted on April 17th, 2023.
Make sure I'm clear on this, because right now I'm not.
Okay.
You think that the stock market has priced in a recession?
Yes, I said that 4 months ago on Closing Bell with you. I say that again today. Stock.
Multiple. And when you look at this data, you actually see that this kind of like 16 times to 18 times makes sense. I think Joe is completely spot on that in the middle of October is when we were really discounting $220 earnings.
Expanded to 18 times, which is far above the historical multiple. I just don't see that as pricing the recession. Now, I agree with you that now we're not going to hit the old lows.
To summarize, all 3 agree that a recession is coming, and that the October 13th, 2022 lows are the lows and will not be breached. Joe Terranova and Jenny Harrington believe that the October lows priced in the recession, and the trough earnings on the S&P will be 220, and Steve Weiss is skeptical about that. An argument can be made against Joe Terranova's statement that the S&P 500 priced in the recession on October 13th, 2022 with those lows as follows. So economic indicators suggest that we're headed into a recession. However, we don't know when the recession is going to begin. Some thought that it would begin in the beginning of 2023, then it kind of got pushed back to the middle of 2023. Now it's being pushed to the second half of 2023 or even early 2024. So I'll call those who control the price of the S&P 500 the market. So basically, the market does not know when the recession is going to begin. However, the market knew on October 13, 2022, how bad the recession would be, at least at this point, 18 months prior to it starting. This is Tony Dwyer. I'm going to play 3 clips of Tony Dwyer. This first one is him pointing out the data that suggests that we are going into a recession. The second one is the empiricism, or what happens to the market when the economy goes into a recession. And the third one is the intuition, or why the market does what it does when the economy goes into a recession. This video was posted on December 1st, 2022.
Tony, that when you look at the yield curve, what you see is the bond markets pricing in recession. What do we need to see out of the equity markets for you to believe that we are starting to do that as well? There does seem to be a disconnect.
It really, breadth comes in and you go back and retest the lows. It would be historically unique. So there's 3 things that, Mel, that we're looking at, and the viewers can track it. The 3 things we're looking at, it's not just the yield curves. Anytime the percentage of yield curves that are inverted gets above 55%. So you don't use the 210, the 3 month, people pick whatever one they want for the day. Let's use them all. Anytime you've had more than 55% of them inverted, you've gone into a recession. We have 82% as of early this week. We had 82% of them inverted. The leading economic indicators, anytime that you've had them at the current level, you've been in or going into a recession. And the Philly Fed diffusion at 1-month diffusion index, which is kind of an interesting indicator. It looks at really the 4 different labor metrics for each state, and the Philly Fed measures it versus a month ago when it's hit this negative a level, you've gone into recession. So I'm not, you know me by now, Mel. I change my opinion like 50 times a day every time there's a tick. So I got to go by the data. And the data is very clear that it would be historically unique with these indicators the way they are not to go into recession. And it would be historically unique for the market to not bottom during the recession. In other words, you haven't made the low yet.
TD.
So Tony Dwyer thinks that we are headed into a recession, and the October 13th, 2022 low should be taken out after the beginning of the recession. Another Tony Dwyer clip, this one from March 28th, 2023.
Your explanation for why you say you expect the S&P to test its October lows by midsummer, and could it go beyond that?
Well, it'd be historically unique not to from two fronts, Tyler. So the first one is the S&P 500 since 1957, when it became a 500 stock index, has never made the low. When it's down 19% in a cycle, when it's ever been down 19%, it's never made the low, the absolute low of that bear market prior to a peak in the 2-year yield. So that just happened, believe it or not, it was literally 2.5 weeks ago. So that would mean it would be the first time that if October is the low, that would happen, number one. And number two, if we do go into a recession, again, all the data points in that direction. Now people are kind of jumping on board with that. If you do go into a recession, the S&P 500, again, in the same time frame since 1957, has never made the low before you even enter the recession. So it typically happens about 23 weeks in.
And just to reiterate, since the inception of the S&P 500 in 1957, for every sell-off of at least 19%, the S&P 500 has never made the low prior to the peak of the 2-year U.S. Treasury yield. And also, since the inception of the S&P 500 in 1957, the S&P 500 has never made the low prior to the beginning of the recession. Clip from this video, which was posted on April 28th, 2023.
Well, it may not reverse, but I mean, I'm looking at the House view over at Goldman today, and their argument, Tony, is that if this is a slow dragging credit crunch, it subtracts 40 bips from annual GDP, which they say would be a pretty tidy outcome.
Carl, so I think the worst case scenario is the one that all the people like me are dreaming about, a soft landing and muddling through. All that does is keep the yield curves inverted. And remember, we look at the percentage of yield curves inverted. What's not being talked about in all this banking issue, Carl, is the impact on private credit. Remember, so much credit now is not in the banking system. It's non-bank lending. We have no idea how that's acting with a continued historic inversion of the yield curve. So when we think about let's say that employment stays okay, let's say that the economy has this mystical soft landing or rolling recession, that'd be fantastic, except that's the one thing that's going to keep the Fed higher for longer. How's that working? What we know is that it's negatively impacting the banking system, and we also know that it's keeping the yield curves inverted. So if you have less banking, lending availability, if you're already at full employment and the continuing claims in the employment trends index are already telling you you're heading to a recession on that front, so you're not going to get increased pay there, where are you going to get the money to increase the growth rate in I would call it a zombie slow growth environment? So unfortunately, history is very clear. You need a dramatic drop in the Fed funds rate that will uninvert or give a positive slope to the curves. That's what bottoms the market in a recession. It's not because things are great. It's because things are so bad that the outlook for money improves because the Fed drops rate enough to incent forward-looking money indicators.
To summarize, in the first video, Tony Dwyer explained that the economic indicators suggest we're headed into a recession. The second video, he points out that the market has never made the low prior to the beginning of the recession, or even the peak of the 2-year yield. And in the third video, he explained that the reason why this is because it has to do with an access to capital and liquidity dries up, and then the Fed needs to drop rates and the market sells off while this is going on. When looking at a sequence of events of economic expansion and contraction, it makes sense that the market would react to the yield curve inversion and the lack of liquidity brought by it, and this is what causes the market to go lower and then make the low after the beginning of the recession, versus the market pricing in the recession 18 months before the recession even begins and making a low then. In order to analyze whether 220 are the trough earnings for the S&P as stated by Joe Terranova and Jenny Harrington, I went to this website and I extracted data from this link here. And from this, I made this spreadsheet. This column is the recession, if there is one. This is the quarter for all the data. This is the revenue per share for the quarter of the S&P. This is the quarter over quarter change. This is operating earnings for the quarter, quarter over quarter change in operating earnings. This is the margin of operating earnings divided by revenue, and same thing with earnings per share for the quarter, quarter over quarter change, earnings per share over revenue, and then this is trailing 4 quarters revenue, trailing 4 quarters operating earnings, and trailing 4 quarters earnings. So if one were to analyze previous recessions using this data, it only goes back to 1988, and really the earnings go back, the revenue only goes back to 2000. So starting with the dot-com bubble or the 2000 recession, there was a decrease in earnings while the revenue was going higher, still going higher, which obviously is a result of margin compression. But then revenue declined and earnings continued to decline. And we see the same thing. Even better example of this is the financial crisis or Great Recession, where you can see the revenue is continuing to grow while earnings are declining as a result of margin compression. But then revenue rolls over and starts to decline, which causes further decline in earnings. So to apply that, and then COVID was it was such a sudden recession, it's probably not the best example. So if we look at what's currently going on, we have earnings decline while the top line continues to grow, perhaps due to inflation. And then what you could expect, instead of earnings continuing to go higher to say 220, you could see a rollover or a decline in revenue, and then a further decline in earnings. So the idea, it wouldn't be unheard of for the market for earnings to go down to say $200 a share. And if you have top line decline, margin compression, further decline in earnings down to 200 or maybe even lower, and then you put say a 15 multiple on $200 a share, it puts the S&P of 3,000, which takes the S&P below the October lows. I think that Joe Terranova and Jenny Harrington would point out that earnings for Q1 2023 were positive, or there was growth. However, the recession hasn't begun yet, and if we go into a similar sequence of actions as far as earnings decline due to margin compression, and then revenue declines, which causes further earnings decline, one could see how earnings could get back down to 200. I do not think that this 27.5% sell-off and the low made on October 13th, 2022 was the pricing in of a recession. I believe that this sell-off was a reaction to the change in Fed policy and not a result of the change in Fed policy, and this is why. Before one can explain the sell-off from all-time highs, one must first explain the move to all-time highs. And I would explain it as follows. This is the federal funds target rate, which was around 0 after the financial crisis, then it moved up, and then after COVID went right back to 0. And then this is the Fed's assets, so the balance sheet expansion. So after the dot-com bubble, it was about 750 billion, less than $1 trillion. Then after financial crisis, it went higher to 2.5 trillion, got up as high as about 4.5 trillion. And then COVID hit and it spiked higher to almost 9 trillion in February, April, May 2022. And this was the case with all central banks. So you had a tremendous amount of liquidity driving the market higher. And all this liquidity drove up the valuation of the market. This is the metric used by Warren Buffett, which is the market cap of the market relative to GDP. And as you can see, the most recent all-time high, it reached about 200%, which is the highest it has been at least since 1971. This is a chart of the S&P 500 going back to about 2000, where each bar represents 1 month. And as one can see, largely due to central banking policies of a low interest rate environment and quantitative easing or expansion of balance sheets, there was a move off the financial crisis lows all the way up to here, and then COVID sell-off, and then an even greater expansion of balance sheets, which caused this huge move up here. And now I'll explain this recent sell-off. This is inflation or CPI, and as you can see, it was moving higher into 21, into even mid-22. As a result, the Fed started raising rates in March of 2022 and going from quantitative easing to quantitative tightening, or instead of expanding their balance sheet to reducing their balance sheet, starting in, say, April 2022. And this caused an increase in the two-year yield, which represents the short end of the yield curve. And this is a chart of the 10-2 split. So you can see the yield curve went negative really in July of 2022. So as a result, in anticipation of the increase in interest rates and the move from quantitative easing to tightening by central banks around the world, the market made the high in January of 2022 in anticipation of this, which started in March of 2022. The market went from very, very expensive to less expensive. So very expensive in January 4th, 2022 to less expensive, but still expensive in October 2022, which right now is, according to this metric, is as expensive as the market was at the peak of the dot-com bubble. So the market started to sell off in January of 2022 as a reaction or in anticipation to a change in the Federal Reserve policy, which started in March of 2022 and made a low from being very expensive to less expensive, but still expensive in October of 2022 as a reaction to the change in Federal Reserve policy. And I suspect that the market will roll over and take out the low as a result of the change in the Federal Reserve policy, meaning as a result of the effects of the recession. In conclusion, the 27.5% sell-off of the S&P 500 to the low made on October 13th, 2022 was a reaction to the change of Federal Reserve policy, and the S&P 500 is expected to make a new low below the October 13th, 2022 low as a result of the change in Federal Reserve policy. As far as positioning is concerned, the S&P 500 is expected to make a new low, but it's not guaranteed. And even if the S&P 500 makes a new low, the lows may already be in specific names. Therefore, a portion of funds long in specific names does make sense, but not too much. Short selling is a losing strategy and not suggested. A significant portion of funds in fixed income paying 5% does make sense and is recommended. And other than that, just solidify the list of names to buy after the anticipated sell-off.